Ladies and gentlemen, welcome to this afternoon webinar. For those who join us for first time and you're going to watch it also later on the recording when we upload it on YouTube, my name is Theo and I'm here to introduce you to your host Jens and pass it on to him. So before we start, just to make sure you know about the YouTube channel, whatever we do, we upload it here on the YouTube, and it's a great social network to keep an eye on. Please make sure you subscribe and you enable your notification button. Trading Spotlight, it's where everything goes after we record. Also, if you're not participating and you want to participate on the live trading I do every single day, please make sure you subscribe on that. Also, every day you're gonna find reels and stories and valuable content on the Instagram. So please make sure you follow us on the Instagram. And the last one I would like to make sure you is the Telegram channel. Now we enable the conversation activity, I can say. So on the post you can reply. People, they start talking about the trades they take, and I reply back to this. I look at it all the time, so you are very welcome to use it, and it will be great to see you also posting and commenting. So today it's the last trading day for this week. We had a bit of a turbulence in the markets, I can say. We had some strong selling on the currency pair, some strength early the week on the US dollar. There it is. Jens, hello. No, we cannot.
Yeah, that was the yeah, there was still yeah. Hello, Theo, how are you?
I'm very well. How are you?
Well, yeah, doing good so far. So I'm in a trade right now. I just hope that my thesis plays out, given what we've seen here from FED and Chairman Powell.
Okay.
By the way, this is a very authentic today. So what we will discuss and listen to, what I prepared, is in fact that the trade is derived from all the thoughts around the FED, especially, but also from the ECB. And
yeah,
I mean, just give me your impression. Do you think that that was very restrictive from Powell last week at the FED meeting, respectively, also on Tuesday? Would you say that was surprisingly restrictive?
Yes, at some extent.
Okay.
And look, for me, purely based on the market structure and where the market start reversing, it's everything started from that impressive deviation of the non-farm payroll.
Yeah.
And then it followed up by statements that they should validate the non-farm payroll events, the numbers actually, and it's trying to make sense.
I think the key event will be inflation next week, no? So I think next week, if inflation comes in, well, I'm not really sure what hotter means, but something above, let's say 6.5, let's say 6.6 or 6.7. Yeah. I think that's well, I'm not sure if it will be a nail in the coffin, but at least we potentially will drop more significantly, especially in equities, I think.
Yeah, you are right, very right. And as recently as I read a few days ago, I think, about the Fed, they are hoping that what they're going to do, it's going to bring inflation to 2%. I'm very skeptical. It's like,
let's say 2025.
Yeah, I can't comment on that in that extent, because 2%, they are printing unlimited currency. Everything is changing. The world order is changing so rapidly.
I have a joke here in this regard. So I think Bitcoin fixes this.
Hopefully.
Shall I share my screen?
In 30 seconds. No,
Sure.
just give me a sec to make sure. Yes, I think you can now.
So
Okay.
great. Yeah, thanks for having me. So I think
Pleasure always.
I think the announcement of the event is slightly wrong, because on the website it still reads that we'll cover the non-farm payrolls today. Well, we won't.
Yeah.
Because
Oh, that's okay.
because non-farm payrolls were last week. But what we want to do today is, in fact, we also want to certainly talk about the non-farm payrolls once again. And in addition to that, also want to have a deeper, detailed look on what to expect, especially after the rate decisions. Already 2 days before the non-farm payrolls were released, that was on Wednesday with the FED. And in addition to that, also we want to have a look at the ECB, which came in 1 day later. So it was FED, ECB, non-farm payrolls, and now we want to use all delivered comments, respectively details here, and then make a whole picture out of this. In fact, I'm right now short the I'm not D but gold right now, and as of now the trade is playing out nicely, but I'm not really sure how this will play out, and how I plan, in fact, to manage it if I really want to roll it over into the inflation numbers next week. Why the inflation's number of importance? That's something we also want to dig deeper into today. Or if I'm probably, let's say, hoping at least that there will be some kind of flush out. Let's see how today's price action plays out. But in all in all, if we put all this together, everything I present to you is in fact my game plan, respectively, what I'm looking at right now and how I trade it in the current environment. I will also give you some ideas of how I identified this trading opportunity based on the fundamental catalyst, and then how I played it here in gold, and why I choose gold, for example, over, let's say, a bounce play in US dollar, let's say in Euro USD or in dollar JPY, because long thing short already, and I can point this out here. The structure is way cleaner, as you will see. Before we start, please read carefully the risk disclaimer. It's very, very important that you understand that there's risk involved when trading the markets, and especially when trading leverage products here in this regard. If you come across any, let's say, trading setups here or game plans, which I present to you, and you plan to take the trade, please be aware that you take full responsibility and take all the risks in this regard. So you might lose money if my idea does not play out. On the other hand, if it plays out, you can keep all the profits for you. So please read very carefully the risk disclaimer in this regard. Everything I present to you is purely educational content, and just gives you an idea of how I think through a trade, how I build a trade into a trade, and then how I also execute on my plan. I think we can, in fact, right now skip here the rest of the presentation, because everything around the presentation was already or the introduction of admirals as a marker has already been taking place, and was done by Theo. So we can head over here into the Fed Watch tool in this regard. This is very important, and something we will use here in the upcoming minutes to get a better idea of what the bias in the market is right now. But in addition to that, I also like to point out, or head over to last week, Wednesday, on the 1st of February. And what we do here is, this is a tracker, can we call this so? So it's like a how can we call this? It's a summary probably. It's a ticker. Yeah, probably it's a ticker. That's probably the best way to put it here. It's a ticker from the Fed rate decision, respectively, not just the rate decision, but especially from the comments from Fed Chairman Powell, which he made here after taking questions from journalists. I'm not really sure. No, it's here. So this is the first paragraph. It reads what happened. So what did the Fed do last week? Well, they raised interest rates by 25 basis points as expected. And Federal Reserve Chair Jerome Powell, so Jay Powell here, then held a news conference in which he said that the economy's disinflationary process had started. I think, given what we've seen in the market, let's head over here to the charts already and have a look here at in this context at the price action we've seen here following. Let me just probably use this here, and then we go to the first. So this is the starting point, and probably we make this not red, but let's use here this one. Can you still see that? I hope so. So that's the line when this press conference, respectively, the rate decision took place. And then have a look here, what happened. So we traded, we came into this Fed rate decision quite bullish already. We started quite bullish into the year 2023. And then, as you can see here, we saw an attempt already into the Fed to take out here the levels of the highs in December, respectively November, failed initially, and then Powell took over and market took off. So the NASDAQ in this case. So we're looking here at the NASDAQ because especially tech titles or tech stocks in this context are prone to sharper moves, let's say, given that they have a higher, how can we call this? Sensitivity, probably. Higher sensitivity to yields in this regard. And so you can see that here. So we took off and we pushed significantly higher, attacked the levels here. We tested in September. We weren't able to reach the August highs, but we took on massive bullish momentum. And not just that, but here you can see there was another day. That was on Tuesday. There was also a push higher. So we came in, we pulled already in a little, let's say, so it was a little extended on the upside. We came in. So technically speaking, well, that was an extension and we just rolled over here. Okay, fair enough. But what's interesting is that this day, and let's probably go to a 50-minute chart. And this is something you can also spot here. There was a quite elevated volatility, and there was a spike higher, flush lower, and then a quite aggressive push higher again. So we didn't really learn something new in terms of the price action itself, but we learned how the market reacted to another press conference or comments from Jay Powell, which he did in Washington that day. So there was an event taking place, and Powell confirmed what he just said 1 week earlier in regards to, well, the disinflationary process has already started. So if you hear this, you might say, well, this is great, because if now inflation comes down and the main target, and you just heard it, as Theo pointed out, the main focus is here to bring inflation down. If this process now has started, that inflation is coming down, that means, on the other hand, the Fed will likely cut rates rather sooner than later, respectively, at least not hike rates further. And this is exactly what market participants, in my personal opinion, interpreted in these words. And what was the reason here for this bullish drive we've seen? As you can see here, so this is the 1st of November. February. I'm sorry. This is where the Fed took place. So there was no real action before, and then we took off with these comments. Why is this surprising? Well, it's surprising because what Powell said here was not just only that the disinflationary process has started, but there were other comments which are worth pointing out, especially don't expect rate cuts in 2023, for example. So that was one thing he said. That's a striking comment. So this is not something, okay, well, okay, then he said this. No, this is noteworthy because if you look at the Fed Watch tool, and here we have a chance to see what kind of probability do market participants with which probability do market participants expect which target rate to be found in the future? So this is like looking at the futures market. As you can see here, if we head over to December at the end of 2023, so this is what this line refers to. So if we say don't expect rate cuts in 2023, something we somehow knew already. And why do I say that? I say that because, and this is also a chart we shared several times in the past. This is from the last, or the last economic projections, which were released in December 2022 at the last Fed rate decision, shortly before Christmas. And here you have the so-called dot plot, and the dot plot tells you what do FOMC members who are eligible to vote here on the rates, or the target rate in this case, what do they expect the target rate to be in this case at the end of 2023? And as you can see here, so this is where we ended 2022. That was with 425 to 450 basis points. So we have now another 25 basis points, and we have another 25 basis points to be expected in March. So then we are at 475 to 500. And you can see that most of the FOMC members here in the economic projections in December said, well, we expect rates to be at 500 to 525 basis points here. So this is where the most dots can be found at the end of the year. So that means if we continue to hike rates by another 25 basis points, let's say in June, for example, well, the Fed says, and then we stay there at 500, 525, and we stay there till and beyond 2023. And then we will see how things develop in terms of inflation. Will we continue to see the disinflationary process to continue and inflation coming down? How does this restrictive monetary policy path we are following here affect the overall US economy? Do we see a massive impact, negative impact on the employment situation, for example? Do companies go out of business? Whatever, does the restrictive monetary policy approach affect in a negative way our economy? Doesn't it? And then adapt accordingly the monetary policy approach. So that being said, means we knew this already. But if we then head over here to the Fed Watch tool, we can see, and also something we made here a topic in several Trading Spotlight webinars and in regards to the fundamental situation where we find ourselves in, well, that was something the market completely ignored. So if you here scroll a little lower, so you don't look at the columns anymore, but you look here at the data. And what you can do is you can say, okay, where we stand right now, but also where we stood one day earlier. So that was on the 9th of February. Today is the 10th. Where did we stand 1 week ago? You can already see there's a sharp shift here. So for 1 week earlier, that was before the non-farm payrolls were released, you could see here that the market saw, that the market in fact saw here that was after the non-farm payrolls, but it wasn't before, that we topped at 475 to 500. Right now, we are starting to roll into the direction of what the dot plot suggests. And that's not all. But if you go 1 month earlier, so 10th of January from today, you can see that here, 1 month, the majority of market participants, with a likelihood of nearly 50%, slightly above that level, in fact, was expecting the target rate to be at 425 to 550. So that was 50 basis points. Yeah, in fact, it's 75. No, it's 75 basis points. It's 75 basis points below what the Fed said. So putting things together here, the Fed says this is what our voting members expect the rates, target rates to be at the end of 2023. And the market says, well, you can say whatever you want. We expect the target rate to be, in this case here, looking at the Fed Watch tool, with an increased likelihood of more than 50% of the market participants to be at 425 to 450. That was very interesting because the market knew better, let's say, or ignored what the Fed was saying. And so now, as you can see, market participants to some extent are caught on the wrong foot, let's say. That's probably a fair way to put it. Because now you see a reinforcement of this rhetoric at the FED statement last week on Wednesday. And in addition to that, even then, it didn't significantly change. But then the employment situation came in, non-farm payrolls last week. We made it a topic here, and it came in significantly better than expected, over 500,000, wherever that number came from. So we made some jokes about this, like it's an 8 Sigma event, for example. So highly unlikely. But however we put this, if we put all this together, then the market is caught off guard, let's say. And that's even more interesting because now, if we say, okay, the recent rally we've seen here from the beginning of the year in January, in this case in the NASDAQ, the rally we saw here and pushing higher, well, that was mainly driven by in anticipation of a more dovish tone or dovish monetary policy approach from the Fed, as the Fed is right now suggesting. Well, then right now, this story is over. And then if you continue to push higher, that's something which doesn't make sense. So higher rates are usually bearish for equities in this case. Certainly you might say, well, it's not as bearish as we've seen it now affect markets in 2022, especially. So most of this drive lower was because the market was extremely dovish into the end of 2021. And then things started to change quite quickly, with inflation picking significantly up and accelerating massively on the upside, and a very restrictive monetary policy path, which was followed. But still, it's not positive. So, and especially right now and short term, you expect the market to react in a negative way on such news. So that being said, means well, we are waiting for a corrective move, which now seems to shape here, let's say. So we are rolling over now, and especially yesterday, the price action was very interesting and I think telling, to be honest. So when you look here at what happened, there was steady and selling pressure, which we could see. And right now, as you can see here, we dropped already in the pre-market, with European markets now also being under pressure, and the DAX attacking, by the way, a very significant region around 15,270, 15,300 around. Let me just check it out here. Bouncing already, by the way. So we already saw an attempt to break lower here. So that was a significant level. If we break that level, I think the DAX is headed for 15,000. And it's likely that we'll break below that level, especially if we get support from US equities, or don't get support. That's probably a better way to put it. So if we can make it back here above, and this is around, I say 12,300, 330 in case of the NASDAQ, then we are likely continue lower and are about to test the region around 12,000 points rather sooner or later, I think. So right now, well, we can stabilize a little, but given the overall BS which was formulated here, and now the market realizing, okay, well, this is not something which is positive for equities, but more likely to be interpreted bearish. I think as long as we trade below the lows from yesterday and can make it above that level, the overall bias short term is on the downside, or not the bias, but the advantage can be found on the downside. And I think we have a very high chance to then push towards 12,000, probably already today, which is also one reason to be skeptical in terms of the DAX. And with the push below 15,270, 15,300, we also have another potential, let's call it action level on the downside for further room, which might, or the door, which might be open then. So that's in regard to the NASDAQ and what to make out of this and how to trade it right now. We also pointed out, let me just probably here head over to the website and head over towards the Forex calendar, which you can find under admiralmarkets.com, and then here, analytics, Forex calendar. And what we want to do is now we want to work with Monday to next day, Friday. And then let's check all boxes here from let's call them G8. Is it G8? Yes, to some extent. I'm not really sure if New Zealand is in the in G8, but however, so it's at least G7 plus New Zealand probably. And then we also here check the box for the highest impact, and then click on apply filter as I already did. And then you can see you have now all events next week, which are of high importance here, pointed out. And our main focus is on this data set here. Tuesday, February 14th, Valentine's Day, inflation rate will be released. So, oh, that's interesting. Now I have a forecast. So I was looking for a forecast at tradingeconomics.com. Let me just check whether they have a forecast right now too. So we go to the United States. Yes, there we have it. There's the consensus. So in the morning, I checked it, and then there wasn't one. So TE forecast is 6.3. Long thing short, I'm not really sure if this is achievable. Or, well, it certainly is achievable. Let's put it that way. But I think it's very low already. I think there is not that much potential for surprises. Let's say on the upside, respectively on the downside more. With a print at 6 or even below 6%, and even if we get to see a release around 6%, let's say. I think most of this is likely already priced in, given the price action we've seen here, we've witnessed over the course into the start of the year. So that being said, if inflation numbers now underline what Powell just said, and by the way, let's go back to the press conference and probably not just have a look here at the disinflationary process and don't expect rate cuts, but there was more, he said. For example, let me just see. So here's the comment. This inflationary process has started. That's what he said. And that's what when markets really took off. But what I think is also relevant and noteworthy, Powell says more rate hikes ahead to bring down inflation. And in addition to that, let me just see. Is it above that? Pre-measure disinflationary process. Here. So well, what we could say, well, this is to be interpreted dovish, let's say, because he says it's certainly possible that Fed funds rate stays below 5%. But again, the next step, don't expect rate cuts here in 2023. That means there will be more rate hikes. And I think this was also a comment. I'm not really sure if I can find it right now. Fed against inflation. Fed is waiting. Recession. Ongoing increases. So that's in regards to further steps which will be taken from the Fed. So putting all this together, we come very close to a point where I think, well, it becomes clear that even if the Fed funds target rate stays below 5%, it doesn't necessarily mean that there will be cuts to be expected in the second half. And if this is the main reason why markets have pushed higher here and inflation now stabilizes, let's say, above or around 6%, as it seems likely given what we forecast for the numbers to be on Tuesday, well, this is something which I'd be really careful about in terms of long engagements, but where I could imagine that we'll have trouble to take out here the recent marked highs around 12,700 around and push above that and then continue to push higher. So in terms of the NASDAQ and especially the inflation numbers, if they, let's say, don't come in cooler than expected, and in this regard around 6%, I think there's a high chance that there will be another flush on the downside, which will bring us at least down here to this breakout area, which can be found in this regard to around 12,000 points. And even the push below that level seems seems an option. But then on the other hand, the thing is, well, to some extent, equities do not make a weak impression on me. So I was surprised to see this push higher. I was surprised to see that last week. I was surprised to see that again then on Tuesday. But even if I'm right, equities are right now not as aggressively sold on such hawkish or restrictive monetary policy approach being followed from the Fed as equities were sold over the course of the last year. So putting it differently, this is not, let's say, a play of relative weakness. That's probably a better way to put it. But a play of relative weakness to play such a restrictive stance, I think can be found here when it comes to gold. And why do I say that? Well, first of all, here, that was the sharp bounce we got to see. That was from, I think was November. It was November when we started to push significantly, aggressively higher, when inflation cooled down more aggressive than initially anticipated. Gold already sold off quite sharply after marking new all-time highs after the invasion of the Ukraine here in February 2022. So we bottomed then and then took a sharp bounce from here and also drifted higher. You probably recall that into the close of last year, I was talking about gold being now in a bullish seasonal window with a potential drive higher than here on the upside, which could, after reclaiming 1,800, push us quite quickly to 1,900, probably 950. And in fact, we reached that level. So we really got a little, I'm not sure if I can call this parabolic, but we went quite sharply up on the upside. And now have a look here when this started. So that was at the end of 2022. So that was after the last Fed release and into the yearly close after the last economic projections were presented. And with the market, given the Fed watch tool, especially with the market saying, well, we don't expect that the Fed will deliver as they say in their dot plot. So again, let's have a look here. We want to properties, parameters. Perfect. Okay, it's the 15th. So that was the day of the respective. No, it was the 14th. So this is where we started. So this is where we started. So this is where the rally started. That was when Fed Powell, or respectively the Fed, delivered their remarks, their dot plot, the last economic projections, and from where we took off, in fact. So it seems it's a combination of a fundamental fundamentally given picture, what the market interprets into what's delivered, and in addition to the bullish seasonal window, which can be found from mid-December till the end of January. So this combination alone still is then accelerating here the trend on the upside. And as you can see here, that was last week, we came in quite stable around the Fed, and the Fed did not deliver any sharp remarks or impulses, but things changed dramatically then on Friday with the release of the non-farm payrolls. You probably recall last week when we had a look here. So probably scroll a little over here. So that was when the non-farm payrolls were released last week. Oh, by the way, this is a 5-minute chart. I'm sorry. So we have to here. So this is the non-farm payrolls release last week, and you can see we started out around 1,900 and pushed aggressively lower from there, and this is what now I think is very interesting here to note. This is an hourly chart right now. You can see that we saw already quite a sharp pull in that was starting on Thursday, and then we accelerated massively on the downside on Friday. Yeah, that was the day I'm looking for. And then you can see we, to some extent, look quite extended, let's say. So given where we started, that was around 1,960, and we bottomed around 1,860. So this is $100 per ounce, which we really flushed within 2 days, and was a very aggressive move on the downside. And well, what do you expect if you see like such a strong move in one direction, especially after, let's say, a time of bullishness, which we can certainly spot here. So we saw a very strong uptrend, right? So, well, what do you expect in such an environment? What I expect is buyers stepping in. So I expect that there's some kind of sharper bounce, or that there's like let's see if we can reclaim 1,900. Really, buyers saying, okay, we weren't capable of capitalizing on the move higher, but obviously the overall bias towards gold shifted, and then we're buying now below 1,900. I think risk reward wise seems a good bet. So that's at least what I would expect to happen. What we got to see was this. So like, well, there's some kind of bounce, sold off. Some kind of bounce taking out slightly the high, again bounce. If you carefully watch, what you get to see here, in my personal opinion, is we are forming a bear flag, right? That's at least what I see. And I see buyers not really aggressively stepping in here. And what I did now, I anticipated the break, in fact, of this bear flag. Usually, I'd say you have here with the break below 1,875. That was, in fact, yesterday. You have here the break out of this flag on the downside, risking against the highs. I was already taking the position when we pushed here towards 850 and then started to roll over again. That was already on 8th, so Wednesday, I think. Wednesday around 880 against the higher end here of this range, and rolled over. We didn't break lower, but we also didn't really significantly take out the highs yesterday. Rolled over here. If we take out the highs, then I don't have a trade anymore. Small loss, and then look for a better spot. But instead, we rolled over and pushed aggressively out of this channel now. And right now, as you can see, holding below 1,870. And that being said, I think underlines that right now, sellers are definitely in control. And there's a high likelihood that this first impulse lower will continue on the downside, because the market is now shifting. It's clearly shifting towards a more restrictive stance. If you anticipate a more dovish stance from the US central bank here, over the course of the last, let's say, 3-4 months, the fourth quarter of 2022 here. And this is now shifting because the market was not believing what was delivered, and inflation came in lower than expected, and fueling, let's say, speculations around a more expansive monetary policy approach from the US central bank in the second half of the year 2023. That was potentially one of the fundamental drivers higher for gold. But as you can see right now, well, this tide is turning. So obviously this is not given anymore, which makes it likely that we will continue to reverse at least some, if not all, of the gains we've seen since the beginning, especially of the year, and that a potential target on the downside, coming back here to the hourly chart, a projected target can be found around 1,000. $820, 810 probably. So as you can see, so very roughly, but as you can see here, well, probably not as low as that. Probably we go to 1,840, but still there's room on the downside. There's further room on the downside. And again, another catalyst is found with this inflation data released next week on Tuesday. So if inflation data comes in hotter than expected, above the expectation, which we had here pointed out, as you can see, 6.2 comes in at, say, 6.3, 6.4, slightly above, still below what we've seen in the in the month before, but still above expectation. I think in addition with the employment situation and with the comments from Fed Chairman Powell, I think there's a significant chance to get to see another flush lower in gold in this regard. And now the thing is, the question is, well, how do I manage the trade? So right now I have a stop level at 1,815. So I'm sorry, not stop level, take profit level on the downside. And I said, well, you know, right now I'm in a driver's seat. So my stop is above the highs from yesterday, 890. So small risk of 10 USD per ounce, a small position. So no big deal. And in fact, so nothing to really worry about, let's say. What I prefer certainly now into the weekly close, let's see what US markets do. Very difficult because there's no further fundamental drivers now into the weekly close. But I say, let's say, I hope, or what I'd like to see is a break below the lows which we marked here in the morning. If we go below 853, well, then I can trail my stop to 870 around. So into here, these highs, the morning highs, on an hourly chart, and then just say, well, you know what? And now let's see. So, well, I'm in at around 880. So 870 means I'm trailing my stop now to a profit of 10 USD per ounce. Well, and then let's see if we get to see the sell out, let's say, on the inflation print on Tuesday, if I'm not getting stopped before or not. Well, and this is in fact how I plan to manage the trade right now, and what I plan to do in this regard, and all based on what we got to see from the FED and what we got to see from the comments, especially from Jay Powell, in combination with the non-farm payrolls release. So that's it on the FED in this case. So the US dollar right now, the counterplay, let's say, to gold short is US dollar long right now. So the US dollar caught a bit finally, let's say, especially against the euro, which pushed above 110, and then as we will see in a few seconds, now is back below 107. And the interesting thing now is that I think most of the recent run, let's probably go to the chart first of all here, this push here to 110, this move higher, especially, I mean, we are talking about the fourth quarter only, so this is 3-4 months. So and we are talking about the most liquid, deepest and most actively traded currency pair in the world. So we have a daily trading volume on average above 5 trillion US dollar, so being traded here. And getting to see such a move means there was lots of billions and trillions of US dollar being traded in and out. And usually you don't get to see such a strong move of here nearly 10, 15, 20% up move from 95 up to 110 around in such a short period of time, just by coincidence, let's say. So that was mainly driven, I think, from the US dollar corrective move, but it wasn't due to the euro and its strength. So right now, and as I've pointed out several times, I'm very skeptical in terms of the euro. And that was on the line once again with the rate decision from the ECB last week on Thursday. So European Central Bank here raises rates by 50 basis points, pledges further hike in March. That means another 50 basis points should be expected. But this is, first of all, mainly priced in. And in addition to that, we should also keep in mind that there's a big gap between the FED's target rate and the ECB target rate. So right now, we are here at 300 basis points. We'll go to 350, while the FED is already above and close to 5%. So there is a potential or positive yield differential when it comes to US dollar compared to the euro. In addition to that, there's no much further room on the upside, given the direct correlation of especially the yields in the southern periphery and here the debt markets there, especially Italy in this regard, and the approach from the European Central Bank. So, or not the approach, but the target rate they have. So that means the more restrictive the ECB gets, and the more restrictive, especially or respectively, the lesser there is a motivation to buy Italian bonds, the more tense the situation gets in the yield market for Italy, which means nothing more than if you continue to hike rates as aggressively as you do right now in terms of the ECB to bring inflation down, and you're not successful, and you need to keep rates at this elevated level, and then things get out of control in the Italian bond market, especially with yields spiking and Italy about, or the debt situation in Italy about to explode or implode. That's probably a better way to put it. Well, then, well, you understand why right now this push here on the downside, this break is not just something which could be seen, let's say, but in addition to that, which is also not yet done on the downside. But I think we have here more corrective potential to this it's not the steeper, but it's the flatter, the flatter trend line. So with a push as low as 105, probably 104, probably even a retest here of the 200 SMA, which you can find here in blue. So that being said, and that having in mind, it's also underlying why I'm quite confident here in my gold trade, because we have a negative correlation. So if gold goes lower, respectively, I'm betting on gold going lower, you expect the US dollar go up, respectively, Euro USD continue to go lower. If Euro USD is about to go lower, well, you in this regard expect US dollar going up, thus gold lower. And another catalyst again next week with the inflation data release, which we get to see on Tuesday. So this is what we are all waiting for. This is the new the new impulse, the new catalyst, which the market is waiting for. And probably the market right now, when looking at the price action, is about to anticipate a stronger than expected or hotter. Not really sure what hot means in this regard, but inflation release, which we get to see. And yeah, so at the end of the day, it's now a game of patience. And as I already said, in terms of gold in my trade right now, let's see if we make lower lows here in this regard. If let's say we're not making new lows, so that's probably a question you might have in terms of my trade. Jens, what do you do if now we hold and we are not breaking lower, but we're taking out 870 on the upside again? I'm probably taking out half of the position in this regard and keeping the rest for a push lower than on the downside. So that's probably my approach in this regard. So taking out the rest, half of the position, probably a little lower than that, 40% or so. Here when we make it above 870, and then keep the rest with a stop above the weekly highs at 890, and then taking it from there. I mean, I'd certainly appreciate the push lower here, and then getting to see a trail of my position for the full position into the profit zone for $10 per ounce. But let's see. I mean, again, it's a game of patience, and that's what we want to wait for. And we get the information right at the beginning of next week, right at the beginning, not necessarily. So Tuesday, we get the news release. So that's it from my end. In fact, I hope you enjoyed this webinar. I hope all is clear, let's say. If you have any questions, please feel free to check out, first of all, the YouTube channel from Admirals and ask your questions below the recording of this event, if you have any questions. And in addition to that, if you come across questions right now here, being a live participant, then, oh, by the way, I'm sorry, that wasn't so smart. Let me just open it once again. So, and if you have any questions now, shoot an email over to Admirals. That will be forwarded to me, and I will answer the question then that way. And that's it from my end. So I hope you enjoyed the webinar. I hope you feel well prepared for next week of trading. And I wish you all the best. Happy trading. Watch your stops, and talk to you again next week on Friday then. Good luck with the inflation release.